everybody. Welcome to our live stream. My name is the original Banani. I'm a content marketing specialist here at CryptoTrader.tax, and I'm here with David Kemmerer, our CEO. So, as you guys can probably tell from my accent, I am not Australian. However, our platform does serve more than 30,000 Australian crypto investors who really want to simplify the process of lodging their taxes. Well, there's one lesson that we learned in building this company, and it's no matter where in the world you are, navigating your crypto taxes is overwhelming, it's confusing, and it's stressful. So to help all of our friends in Australia, we wanted to recruit the help of a real Australian tax expert. So today we're here with Scott Lynch from Beanstalk Accountants. Super smart guy, and I think you guys will see in just a second. He really knows his stuff. How's it going, Scott?
Yeah, it's good to be here.
Glad to hear it. No, we're excited to have this conversation. Before we get started, though, one disclaimer we do have to say: this session is not meant to be financial or legal advice. This is for general informational purposes only. So now that we got that out of the way, Scott, do you mind telling the audience a little bit about your background and how you got involved in cryptocurrency?
Yeah, sure. So a little bit about my background. Started as every young accountant does in the bigger firms, learning all of the ins and outs of tax. I got a little bit sick of how paper-based they were, so started my firm about 7 years ago with basically that whole premise of being paperless and cloud-based and using technology well in our business. So after a couple of years, I went to stress test that, lived over in London for 2 years, running our accounting firm remotely from over there. While I was over there, kind of read a little bit into crypto, wasn't sure too much what it was about, bought a little bit, and that was about June 2017. And then as well, at the same time, my brother had done the same thing, put some money into crypto, and then we proceeded to watch it skyrocket into December 2017, and then crash again in the January. And it was one of those things that was a bit of a wild ride. But after kind of learning that through that experience, we kind of ended up, having a little bit of a specialty in the crypto space that we'd done it ourselves, and it was more one of those things that it kind of snowballed from there with clients that we were helping with their crypto, and we kind of took it all from there.
Awesome to hear. So there is one thing I do want to ask. Every time we do one of these live streams, there's always one guy in the comments who says something like, "Hey, I don't know what these guys are going on about, but you don't need to report your taxes. The ATO is not going to catch you." Do you have any response to that?
Yeah, that's my favorite one that I hear all the time. And it's kind of hilarious for two reasons, in that the easiest way for people to conceptualize what a blockchain is to picture their bank statement and then think of their bank publishing that on the internet for everyone to read. It kind of makes me laugh when people think, no one's going to be able to catch you, because it's actually easier for them to catch you through Bitcoin than it is through your normal bank account. And what happens is that our Australian tax office is actually quite switched on in that regard, and they have lots of data matching teams that are basically trawling through all of the blockchain ledgers, and they're with the fact that they've got KYC with all of the on-ramps and off-ramps in Australian dollars, it's actually quite straightforward for them to pick that up. So yeah, my comment to those type of people is that it's not a matter of if they catch you, it's just a matter of when. So yeah, I give them that kind of thing to think about.
Okay, good advice. Good advice. So imagine this. I'm an Australian crypto investor. I got started with cryptocurrency this year, as many investors did. And I just have no idea how to report my taxes. I don't even know where to start. Is there any advice that you'd give for someone in my situation?
Yeah, so I suppose I'd kind of break it down into two elements. So the first one is, if you've really early in your journey, try and streamline things as much as you can. So don't pick that scattergun approach of having 20 exchanges, 50 different wallets. Try and say, oh, okay, I'm going to do this and this and this with my crypto. Let's pick an exchange that allows me to do all of that in the one location. And that's kind of the first approach. And then the second approach is to use one of the tax aggregation platforms, such as yourselves. So Crypto Tax Trader, use something like that to put together all of the different bits of information from all of those, because you probably will end up with maybe 1 or 2 exchanges and a couple of different wallets, even if you're trying to keep it as streamlined as possible. And so, yeah, using those tax aggregation platforms to kind of put that all together into one nice, simple, easy tax report that you get at year end. And then from our end as your accountants, we've got a nice report that we can take all of the different numbers and populate your tax return with. And for those people that are savvy and want to do it themselves, it gives them that confidence that they've got a report that gives them the right numbers.
Okay, I see. And I'd like to know how long that process takes, whether you go with an accountant like yourself or you just choose to file this tax report by yourself. I mean, if I was doing it and I was based in Australia, would I have enough time to complete it before the 2021 tax deadline?
Well, this is the thing. So you've kind of got your 2 options. If you're going to use one of the platforms that really streamlines things and makes it so much quicker and easier, because you're using that technology, the software is doing it all for you. It takes a long time if you want to break it down and do it all yourself in spreadsheets. So it's one of those things. We actually quoted a client the other day, and they had stuff going everywhere, and they weren't wanting to put it through one of these platforms. And we had a look at all of their stuff, and we kind of had to quote them around about $8,000 to do their tax for the year, which was actually on the low side because they were getting quotes from other accountants, and they'd had a quote as high as $12,000 to do their tax return. And when you think about, I might pay $100, $150 to a software platform to kind of calculate all of that for me, it's a huge, not only time saving, but dollar saving than trying to get us to kind of manually calculate things in the back end for you. So yeah, it's definitely worthwhile using the platforms instead of trying to do it yourself.
Got it. David, anything you want to add on there?
Yeah, I would just say, if you have 1 or 2 or 3 trades throughout the year, then of course you can probably handle that yourselves. But it does, as Scott mentioned, save a lot of time if you have many transactions, especially spread across multiple different exchanges or wallets or DeFi protocols. And so that is, of course, where we excel. And of course, the software that we build really just to streamline all of that. So I definitely would echo what Scott had to say just on that front.
Got it. Here's a comment from Zeus Crypto. Used your platform this year, guys. Thanks. Love it. And then he had the flex emoji. So thanks for that, Zeus.
I'll flex back. Thanks, Zeus.
Well, Scott, one common piece of advice you'll often see on the internet is, hey, if you just hold on your cryptocurrency and you don't sell, you don't really need to file your taxes. So what do you think about that? Is that correct?
It depends on what they're doing, but yeah, it kind of is. So with a lot of the crypto stuff, it is it's a capital gains tax event when you're buying and selling. So if you just use an exchange to buy some Bitcoin and you do nothing else with it and just sit on it, then you're not going to have any taxable events and you're not going to have any gains. The one thing to be mindful though is if you're kind of switching that between coins, then that's something entirely different. But yeah, if you're just you've bought some Bitcoin, you've kept it on the exchange, or you've moved it into a cold storage wallet and you're just sitting on it, then yeah, there's no capital gains from that.
Right. So here in America, crypto to crypto transactions are considered a taxable event. Is it the same thing in Australia?
It is. So if let's say you've got some Bitcoin and you switch that for an Ethereum coin, you've got, that's your tax point there. So use a bit of an example. Let's say if you bought Bitcoin back when it was worth $3,000, and then you held on all the way to now, and then you're at this point in time switching it to buy some Ethereum, you're going to be taxed on that gain from $3,000 to whatever it is now, 50 or something odd today. And then that purchase cost, so that value of the Ethereum forms its cost base now for the gain that happens in the future on that Ethereum. So it doesn't matter that you didn't end up with any Australian dollars or US dollars in your bank account. That doesn't matter for tax purposes. It's when you sell that, essentially sell the Bitcoin to buy your Ethereum is when that taxing point happens.
Yep, and it's the same way in the US, the exact same treatment. So that's easy enough.
Perfect.
Yeah, Scott, I think I remember the last time we talked, you said this is unfortunately something that happens to investors quite often, right? Like they do these crypto to crypto transactions. They don't know that they have to pay this tax at the end of the year, and then they have this huge tax bill, but they might not have the Australian dollars to pay the tax.
Yeah, we see it as quite a common scenario, is that people just they don't understand that, that was a taxing point, and at some point they're going to need to sell down some of what they ended up with to pay the tax bill later on. So yeah, it's one of those things. It's really good to get on the front foot with the education piece and say, look, this is where the tax is going to be, so just be aware of it from the outset.
Got it.
You think there's any good things that investors can do to set aside money in anticipation of the tax bill? Do you recommend that, Scott, for your clients?
Yeah, that's a really good thing to do. It's one of those things that really depends on the type of investor you are. Some people like to have that security. So we've seen clients that potentially, they had a massive rise in their Bitcoin, and they might either sell a portion of it down. They've transferred some to Ethereum and they've sold some down to Australian dollars and kept it in their Australian dollar bank account for that tax. Other people like to put a portion into, say, a stable coin. That it's still it's still technically in crypto, but it's that's not going to fluctuate wildly, and they know they're going to be able to easily use that to pay their tax bill. So they're kind of the two options that I've seen that kind of work well. And then you've obviously got the third option where people will just leave it in their Ethereum, and then say at the end of the year, when they need to pay the tax bill, they'll look at whether they sell that down to pay it.
Yep, makes sense.
Definitely. Scott, is there any other common crypto tax misconceptions you want to clear up while you're on here?
So we've the one we get quite a lot as well is the personal use. So there is a really small part of the tax law in Australia that says you don't have to pay tax if your crypto is, or if your crypto is used for personal use. It's actually really, really unusual for this to apply. Basically, you have to prove that you were using it for personal purposes. So buying Bitcoin and sitting on it is not a personal use case. Let's say, for example, you want to use a service online, or you want to watch a video online, and it requires payment in a crypto coin. If you use your Australian dollars, put it onto an exchange, buy Bitcoin, a couple of days later, then go and pay for that service, that would be personal use, absolutely. But let's say, for example, you and to also give perspective, the limit, there is a hard limit on 10 grand. So if anything above $10,000, then it doesn't apply. But if it's under $10,000, then this personal use provision can apply. And what a lot of people kind of think that with that is, oh, sweet, I can buy 10 grand worth of Bitcoin. And as long as I use it for personal use occasionally, then it's not going to be subject to capital gains. But what the tax office is pretty explicit in the way that they see it. Let's say you convert $10,000 to Bitcoin. You go pay for your product online, it's $100, and you leave $9,900 sitting in your Bitcoin wallet, and then you don't do anything with it for the next 2 years. They're not going to say that's personal use. They're going to say, well, yeah, that first $100 was, but the other 9,900 isn't. So yeah, that's one of the ones that are probably one of the most common ones that we kind of get that, we kind of need to clear up with people.
Right. From my understanding, that exemption is, the requirements are quite strict, right? Like it's rather hard to qualify for. Exactly,
and you really need to be showing evidence of you using it really quickly within that conversion period, and regularly as well. So you might convert $1,000 and you might once or twice a week go and buy stuff with crypto. Then that'll qualify as personal use. And then as well, if you're if the full amount is kind of going in and then going straight out in a purchase, then that'll qualify. But apart from that, it's they're very stringent upon what they deem will qualify for that personal use. So it's kind of really rare unless you're buying something pretty much straight away.
Got it. So we do have a few questions from the audience, and these are some good questions. So keep it coming, guys. Let me see if I can get this up on the screen. I had it earlier, but my mouse is acting up a little bit. There we go. So here's a question from Wilson. He asks, when earning interest and bonuses via staking, how should these transactions be reported? So this is an awesome question.
Yeah, this is really good, and the easiest way we've been able to kind of educate our clients on this is you conceptualize it the same way as what's the closest approximation in normal finance, and that will be the way to treat it for crypto finance. So staking is a perfect example. Let's say I've got my Ethereum, I'm locking that up in a staking contract, and then I'm getting paid my staking rewards over time. At the end of that staking contract, I then get my principal back as well. Easiest way to look at that, exactly the same as a term deposit. You take your Australian dollars, you lock it up in a term deposit for 6 months. The bank pays you interest on that term deposit. At the end of the 6 months, they give you your interest and your principal back. And basically it's treated the exact same way. So when you lock up your Ethereum, obviously there's no taxing point there. And then when you get your initial Ethereum back, there's no taxing point there. But all of the staking rewards are treated as just ordinary income, exactly the same way you would treat interest income on your tax return. The only difference is you've just got to make a record of what was the value of those staking rewards when you earned them, because that will form the cost base of calculating the capital gain on them when you eventually sell them later on.
Got it. So a few more questions here. Well, here's one that David might be better suited to answer. This one's about our platform. It's from Kara. She says, can I use CryptoTrader.tax for last year's calculations?
Yeah, you can. You can essentially just connect your exchange accounts, and really the software will pull in your transaction history from whenever you started using the exchange, and then it will segregate and organize all of your tax reports by the relevant tax year. So in Australia, that's a little bit different, of course, than here in the US, but then you'll essentially just be able to pull the reports for the relevant tax year that you need.
Got it. So here's another question for Scott. This one's from our friend Zeus again. He asks, how would you guys know if my capital gain is short-term or long-term if I bought it on one platform but sell it on another?
So this is part of the main reason why we like people to use platforms like Crypto Tax Trader and not manually calculate things with spreadsheets, because what generally happens is that if you're kind of trying to do it yourself, you'll miss what was actually just a transfer between exchanges. It's where the software will pick up, well, you actually purchased it 2 years ago, but it was purchased and put in an exchange wallet here. You put it in cold storage, moved it to another exchange, and then sold it. So it'll know, the platforms will automatically pick up that there were 2 transfer transactions in there that weren't a sale event, and then it'll pick up the original purchase event and then the final end result sale event.
Got it. David, anything you want to add on to that?
Yeah, exactly. As Scott mentioned, essentially, that's the unique problem when you compare cryptocurrencies to equities or stocks, is that cryptos by their nature are interoperable and transferable, right? And that all the time, you can essentially transfer, withdraw, deposit your crypto into exchanges, your own wallets. And so that creates this cost basis tracking problem of, as your crypto moves from one wallet to the next, the central platform doesn't necessarily know capital gains losses because it was just transferred in. And so that's why you do have to do the reconciliation between your wallets so that you can essentially assess, oh, I see that I'm reconciling, I bought it on, Binance, and then I sold it on CoinSpot years later. And that needs to be reconciled to actually accurately calculate those capital gains and losses. Of course, you can do that by hand, but it can be quicker just to plug it into software and let the software kind of do the hard work.
Well said. So, wow, lots of questions, guys. I love it. So here's another one for Scott. What are the rules around using FIFO, LIFO, etc., when determining cost basis?
Yeah, so basically, it's one of those things that you've got the choice to make, and this is the best thing about these platforms is that it gives you the option to calculate, and it makes it really nice and easy. So one of the things, you just have to be consistent. And so that's where, you can't obviously say, oh, this one I wanted to do LIFO and this one I wanted to do FIFO. You kind of say, okay, across the whole, what you've got in that year, you've got, okay, that's what I'm going to do. Select that tick box in the platform, and then that platform will calculate that for you for that financial year.
Got it. So another question from the audience. Someone asks, how do I treat it from a tax perspective if I'm transferring crypto from my MetaMask account to a friend's MetaMask account?
Yeah, so this is something that happens all the time, and I tell people to just avoid it when they can, is that legally, if it's in your account, you have to pay the tax on it. And if it's, a lot of people end up trying to, oh, I'm going to hold it in my account and do some stuff for them. But that means you're liable for your friend's tax bill. So what you really want to do is, if you want to help your friends with crypto, by all means do it, but set them up on their own account with their own KYC so that it's separate from yours. Because what happens is, if you're doing it all through your MetaMask account, all of the tax on those transactions have to be paid by you. But if you're transferring from your MetaMask account to theirs, that's a sale event because they're a completely separate person. It's exactly the same as if you were trading your funds to someone you have no idea about, as if you were trading your funds to a friend that you know. So yeah, that'd be the way that gets treated.
Interesting. That I did not know it was treated like that in Australia. So here's a follow-up question from our friend Dennis, who asked about FIFO and LIFO. He asks, is it possible for me to use FIFO for 2019 and LIFO in 2020?
As far as I'm aware, yes, you can. So it'd be one of those things. I'm pretty certain that, that is the case, that you could use, as long as you're consistent across that year, and then you close out that year, and then you change method for the next financial year.
Got it. That's good to know. So just a couple more questions from me. I guess the first one would be, I'm sure there's a lot of investors who are tuned in right now who are looking for ways to legally reduce their tax burden. I will repeat our disclaimer from the beginning that this is not meant to be financial advice. But are there any steps that you see investors commonly taking to legally reduce their burden for the year?
Yeah, so there's a number of different strategies that you can do. A lot of them involving, company structures or trust structures. The main thing to note with those is you have to set them up first. So if you've already got your crypto holdings and then it all of a sudden has a huge increase in its value, you can't obviously set up a company at that point and reduce your tax. The company or the trust has to own those assets at the very start before obviously those gains are made. So it's one of those things that we like to get on the front foot with our clients. If they're looking to invest a substantial amount, then we'll try and set up these structures at the start, and that's kind of the best way to do things. And as well, it isn't one of those things that there's a kind of a default structure that's best. It depends on what you're doing. So if you've got someone that's a day trader that's got lots and lots of transactions, and they're treated slightly differently for tax purposes than someone that's just bought Bitcoin and sat on it. So we would, depending on those different situations, we would probably recommend a different structure. But yeah, that'd be the that'd be one of those things we'd sit down and go through your situation and say, okay, what are you planning on doing, and how much capital have you got? Is it worthwhile? A company structure might be fantastic, but it'll cost you X number of dollars each year to keep it going. So you might not have enough capital to make the tax saving worthwhile.
Right. So just to explain a little better for an ignorant American like myself, I believe traders and investors are treated differently in Australia. Is that correct?
Yeah, so basically the difference between an investor and a trader, so basically if you're a trader, you don't get the short-term, long-term 50% discount. So basically you pay tax on 100% of your gains, whereas if you're an investor, you do get that concession. So that's kind of the main thing, is that, you know, with a trader, it's not going to matter too much to them because they usually do have that low hold. They're not holding onto things for long periods of time, but it does mean that if they did have one transaction that they happen to hold for longer, they don't get that benefit on that one transaction. So yeah, that's the main difference between the traders and the investors.
Got it. That makes sense. So last question from me, Scott. This year we've seen a lot of investors get involved with DeFi protocols, maybe Aave, Compound, and things like that. I'm sure there's a lot of people listening in who've messed around with one or more of these protocols. Can you tell us a little bit about how DeFi is treated from a taxation point of view? Love to hear about that.
Yeah, so once again, it's kind of very similar to the stuff that we were going through with the staking before. So if you've got, and it does have different, you might hear the term yield farming as well, but it really just gets treated the exact same way. You look at it in terms of, let's step back and say, okay, well, what am I doing here? I'm kind of contributing, my capital to a pool. That pool is then getting used, and I'm getting paid a reward from being a part of that pool. It's basically treated the exact same way as the staking. Your actual capital that you're putting into those DeFi protocols, there's no tax on when you put that in and put it out, but there is the tax on all of the rewards as just ordinary income.
Got it. That's good to know. And David, can you tell us a little bit about how a platform like ours can help with this kind of DeFi tax reporting?
Yeah, definitely. So the DeFi world has obviously taken a lot of the market by storm over the past 12 months. So here over the next about 30 days, we'll be launching a completely new product that seamlessly integrates with all of these DeFi protocols. And so the user experience will simply be enter in your public wallet address, whether it's an Ethereum address or maybe a Bitcoin address. And then, CryptoTrader.tax will pull in all of the transaction history that was associated with that address and properly classify it into the taxable transactions, whether it was adding liquidity to a pool like Uniswap or earning, interest income from somewhere like Compound or Aave. And we'll handle that all of that for you. So stay tuned. That's coming very shortly.
Yeah, very exciting. As we alluded to earlier, sometimes these taxation can get complicated if you're transferring from one platform to another. So very cool stuff.
Yeah, one more thing to note on the DeFi side of things. So what a lot of people use to determine if they're a trader or an investor is the volume of their transactions. So if you're an investor, you're probably going to only have a few every time you buy, and because you're not buying and selling with regularity. Whereas if you're a trader, you're going to have, hundreds or thousands of transactions. When it comes to determining if you're a trader or an investor and you're in DeFi, well, sometimes you're in DeFi and you really are just an investor. You've put your capital somewhere, but the DeFi protocols will pay you sometimes daily, which means that you might, if you've put an investment in 2 different DeFi protocols, you will probably have 1,000 transactions in the year, but you're still an investor for tax purposes. You're not going to be considered a trader because all of those transactions are just payments of interest. They're not you buying and selling between Bitcoin, Ethereum, or whatever other coins you're getting into. So that's just one thing to note. It's not done on there's no hard and fast rule in terms of how many transactions did you have in the year you're a trader or you're an investor. And especially with the DeFi protocols, you kind of need to look at them as to what the investor's doing to determine that distinction. So yeah, if you're into DeFi and you kind of got thousands of transactions, you're not automatically by default and a trader. You could still be an investor.
Got it. Yeah, I did hear about that. The lines can get pretty fuzzy at certain times. Right. So thanks so much for your insight, Scott. Can you tell the audience how they can reach out to you?
Yeah, so the easiest way is just to reach out to us on our website, so beanstalkaccountants.com.au. We've got a contact us form that you can reach out to our team, and we'll we can get back to you and get going with all of your tax. And then love it if you guys had come prepared with a report from Crypto Tax Trader as well. That kind of makes our lives a lot easier in what we can do to streamline your taxes.
Yeah, love it. So whether you choose to file your tax return through an accountant like Scott, or you want to do it by yourself, we can help. So CryptoTrader.tax serves more than 30,000 Australian investors, and it really helps to simplify the tax reporting process for all the reasons that we mentioned, right? I mean, especially if you're using multiple exchanges and wallets, it can be tough to stay on top of each individual transaction, but you can sync your history with most popular exchanges with us in a matter of minutes. So if you're interested in getting started, you can click the link in the description below. You should also see a link to Beanstalk Accountants. David, anything you want to add on for our Australian friends?
No, thank you for setting this up, Durej. Scott, it was great collaborating with you. I'm sure we'll have to do again more. And everyone, thanks for tuning in. I'm sure we'll be doing it again in the future.